So there was a person named Elliott. He has done research on stock market for many decades, almost more than 50 years, and he has come out with a wonderful theory which still people follow. Although this theory is very old, somewhere in 1940s or between 30 and 40, this theory was drafted, and still this theory is discussed by the analyst or used by the analyst. So if you look at this, he says that market trend looks like waves. Okay, it goes up, down, and there will be 5 waves of rising trend. 1, 2, 3, 4, 5, and then there will be falling, 3 falling. These are called correction. 1, 2, 3. Then within that wave also there will be smaller wave. So you can see within one wave, below if you see there are 5 waves, and within that also if you want to go further down, there will be many waves here. So all these small waves, when they are read together, you get a bigger wave here, and based on that one can get an idea whether the prices are going to rise further or fall further. So you can also try this in the market if you are interested, and sometimes you will find Elliott wave theory proving to be true. So simultaneously write a note. If at all a question will be asked from this topic, one of the most likely question if they ask will be Elliott wave theory, head and shoulders pattern, or maybe yesterday I told you point and figure charting. So these are the 3 or 4 important points possible from this topic. So write Elliott. It is the name of a gentleman who did lot of research on the stock market price movement. He read lot about trends, pattern, and then he came out with certain observations which he has given in the form of Elliott wave theory. Elliott found that the market exhibited certain repeated patterns or waves. Elliott found that markets exhibited certain repeated patterns or waves. Second point, as per this theory, wave is a movement of the market price. From one change in the direction to the next change in the same direction. As per this theory, wave is a movement of the market price from one change in the direction to the next change in the same direction. So these are called waves. All these are waves. Okay. Third point, I will give you time to draw the diagram once we write point number 3. These waves are resulted from buying and selling impulses. Emerging from buying and selling impulses emerging from the demand and supply pressure on the market. What is the cause of wave? Demand and supply. The prices are going up, it means people are demanding here, right? But after it reaches a certain peak here, then they will think now it is the time to do some profit booking, sell, and therefore some selling pressure will happen, but it will not fall so much that the previous gain is wiped out. It will fall only slightly, and again the next peak or the next wave will be much bigger. Next wave will be much bigger, and the peak that it will reach will be higher than the previous peak, and all this is happening because of demand and supply pressure on the market. Investors have certain psychological pattern. So if you can understand the investor psychology, then one will be able to get an idea how the market will behave next, and that is what Elliott has done. Now you can draw the diagram. Now you draw the diagram. Some more notes I have to dictate about this Elliott theory. So write down, on the y-axis we have security price, x-axis is time, first you draw this one, 1, 2, 3, 4, 5, and write there 1, 2, 3, 4, 5, and then it will fall A, B, C. Now here you write A, B, C. In the exam you can draw only this much. However, what this theory says, from 1 also, from start to 1 also, there are smaller waves. So exactly below this one, you can have 1, 2, 3, 4, 5. So to reach this one also, there will be smaller waves, and exactly below 2, you will have 1, 2, 3, like that. Then again to reach 3, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, 1, 2, 3, like that. You can draw 1, 2, 3, whatever. Now they have stopped counting properly. And if you want to draw further, which is I think not required, you can just leave this last one. Within that smaller wave also, there will be smallest or smaller and smaller sub waves. So this is a little difficult task for ordinary person to do this much analysis. You have to be specialist. You have to dedicate your life for understanding these patterns. Then yes, you will be able to make money in the stock market. I hope you have drawn the diagram. If you have less time in the exam, only the upper part. If you have little more time, this also. And if you are having lot of time, 3 to 4 hours you are free in the exam, then draw this also, right? Now I will keep the diagram in front of you so that you can relate the notes with the diagram. So next point, write down classification of waves. Classification of waves. So according to Elliott, there are two types of waves. One is impulsive pattern. One is impulsive pattern. Impulsive pattern into bracket basic waves. Into bracket basic waves. In this pattern, there will be 3 or 5 waves. In this pattern, there will be 3 or 5 waves in a given direction. 3 or 5 waves in a given direction, going upward or downward. Going upward or downward. So like in this diagram, you can say this 1, then from 2 to 3, 4 to 5. These are impulsive pattern. They are going in the direction of basic movement. The basic movement is a rising trend. The basic movement is a rising trend. So these are impulsive pattern. People are going to buy because the trend is buying, trend is rising. As everybody is buying, people, more and more people will buying. So this movement can indicate bull phase. So this can indicate either bull phase or bear phase. Bear phase means down, bull phase means up. The movement can indicate bull phase or bear phase. And then corrective patterns. Corrective patterns means reaction waves. Corrective patterns in bracket reaction waves. Reaction waves. These three waves are against the basic direction of the basic movement. These three waves are against the basic direction of the basic movement. These three waves are against the basic direction of the basic movement. Correction involves, now you see this is correction. It was a bull phase, but some correction in price took place. Correction involves correcting the earlier rise in the case of bull market and fall in the case of bear market. In case of bear market, the market is falling, but then there is a sudden some rise. So that is correcting the bear phase. These are called correction pattern or reaction wave.